Imagine for a moment you've just been handed this huge stack of financial reports, right? Pages filled with numbers, complex charts.
Yeah, it can be pretty overwhelming.
Exactly. And your job is to quickly cut through all that noise, grasp the essential story, and, understand what truly matters without drowning in the details.
Well, that's pretty much our mission today here on the Deep Dive.
That's right. We're taking a deep dive into the latest financial results from Bajaj Auto Ltd. This is for the first quarter ending June 30th, 2025.
Correct. The Q1 FY26 results, which their board just approved on August 6th. And our goal, really, is to pull out those key nuggets of knowledge and insight for you.
Making sure you're well informed, but without that information overload.
Precisely.
And just from an initial look, it really seems like a story of resilience and strategic growth, too.
Definitely. They've delivered a robust financial performance despite operating in what they called a volatile and intensely competitive environment.
Which is putting it mildly sometimes. What really caught my eye, though, is how some of that growth was achieved. It wasn't just straightforward volume, was it?
No, not entirely. Bajaj Auto has kicked off FY26 on a remarkably strong footing, navigating challenges pretty successfully. We're seeing the top line cross 12,500 crore, EBITDA nearing 2,500 crore, and profit after tax, or PTED, coming in around 2,100 crore.
Those are certainly strong headline numbers. Sets a clear tone for the year ahead.
Absolutely.
So let's unpack these numbers a bit more. Looking at the standalone results, first Q1 FY26 versus the same time last year, Q1 FY25. I see unit sales were up just 1% to about 1.1 million units.
Right, a modest increase in volume.
But then revenue from operations jumped 6% to over 12,584 crore, and PE grew 5% to nearly 2,100 crore.
Yeah, and even basic earnings per share, the EPS, rose to 75.1 from 71.2.
So that difference between the small unit growth and the larger revenue growth, that points towards something, doesn't it? What's driving that gap?
That's a really crucial observation. And if you look at the consolidated results, the picture gets even clearer. Total revenue from operations there is up a full 10%.
10%, okay.
Reaching over 13,133 crore. And the consolidated PA jumped an impressive 14% to 2,210 crore.
Wow, 14%.
Which pushed the basic EPS up to 79.2 for 69.6 last year. And here's the fascinating part, answer your question.
Right.
Much of that revenue growth didn't just come from selling more units.
Right.
It was heavily influenced by a richer product mix, selling more expensive, higher-margin products.
Okay. So a strategic shift in what they're pushing. That makes a lot of sense.
Exactly. It indicates a very conscious decision.
So beyond the top line, let's look at profitability. That's always key. What are the EBITDA margins telling us this quarter?
Okay, so the EBITDA margin for Q1 FY26 came in at 19.7%.
19.7%. Pretty healthy.
Very healthy. Although it was a slight sequential moderation, about 50 basis points. That's half a percentage point down from Q4 FY25 and also Q1 FY25, both of which were at 20.2%.
Okay, so a slight dip. Why was that?
They said it was almost entirely down to lower dollar realization, especially during April and May. The exchange rate wasn't quite as favorable.
Right, Forex headwinds.
Exactly. But, and this is important, that improved product mix we just talked about, plus good operating leverage, they really helped offset the impact of rising commodity costs.
So currency was a bit of a drag, but their strategy around product mix acted as a kind of counterforce.
A powerful counterforce, yeah.
That's a pivotal insight. Okay, let's dive into the domestic market then, because that's where these strategic choices really seem to play out. The domestic motorcycle story, it's a bit nuanced, isn't it? Volumes were actually down 9% year-on-year for Q1.
Yes, you're right to flag the nuance there. The overall industry performance was, generally flattish.
Okay.
But within that, the 125cc plus segment actually did better than the entry-level 100cc segment.
And Bajaj made a specific choice there, didn't they?
They did, a very conscious decision to, as they put it, underweight tactical actions in the slim profit 100cc segment. They didn't chase volume aggressively there.
Which meant losing a bit of market share in that specific category.
Yeah, about a 2 percentage point market share loss there. But it seems like it was a deliberate trade-off.
Okay, so instead of just going for volume in a less profitable segment, they focused strategically on the 125cc plus category.
Precisely. They brought in product and pricing interventions late in Q4 FY25.
And did it work?
It seems so. They saw a 3 percentage point sequential market share improvement in Q1. So quarter-on-quarter growth.
Oh, okay.
Reaching an overall 15% share in that more profitable 125cc plus segment. And they've already kicked off a new TV campaign for Pulsar, which is a huge brand for them in that space.
So how significant is this shift for their overall domestic strategy? It feels quite important.
It is very significant. It really shows a commitment to profitability, to leading in valuable segments rather than just chasing sheer volume across the board.
Right.
Now, if we shift over to commercial vehicles, particularly three-wheelers, the industry saw strong growth, up 11% in Q1,
Hmm.
and e-auto volumes nearly doubled.
Big growth in electric. And how did Bajaj fare?
Well, in the traditional ICE internal combustion engine segment, they maintained a very high 75% market share, still dominant there.
Okay, still the leader in ICE. But the electric three-wheeler segment sounds like where the really big news is.
Absolutely. This is quite a moment for them. Bajaj Auto emerged as the #1 player in E3W's electric three-wheelers in the L5 category for the full quarter.
Number one. Already. That seems incredibly fast.
It is. They achieved this leadership position in under 2 years. Retail volumes grew roughly 3 times year-on-year,
Wow.
and their market share in electric three-wheelers shot up by 1,000 basis points. That's 10 full percentage points to hit 36%.
That is a massive leap. What specifically powered that? Any particular product?
Yes, they credit the successful introduction of their 7012 variant. It's a wide-body model designed for large ticketing segments, particularly in semi-urban and rural areas.
Okay, targeting a specific need.
Exactly. And here's something really crucial. This success has actually boosted the profitability of their EV three-wheeler segment beyond the profitability of their ICE three-wheeler segment.
Really? So the EVs are now more profitable than the traditional ones?
For three-wheelers, yes. That's a very impressive turnaround and speaks volumes about their strategy and execution in EVs.
That is remarkable. And are they stopping there?
Not at all. They're set to launch their e-rickshaw product called Elix in key markets by mid-August.
E-rickshaws. That's a huge market, isn't it?
Massive. Over 40,000 units per month industry-wide. Their plan, though, is quite measured. They want to start small and observe the dynamics closely.
Learn the market first.
Right. To basically craft a playbook for upgrading existing lead-acid-based e-rickshaws, the common type, to their presumably superior and likely premium-priced lithium-ion solution.
Smart. Calibrated. Okay, now shifting gears again, what about electric two-wheelers? Cheetah seems to be doing really well.
It really is surging ahead. Cheetah's retail volumes more than doubled year-on-year.
Doubled.
And get this, it contributed nearly 50%, half, of the entire industry's incremental volume growth in electric scooters.
Half the growth came from Cheetah alone. That's significant market impact.
It really is. Their market share for the quarter rose to 21%, which is up from 12% in Q1 last year.
What's driving that success? Just brand recognition?
Partly, but it's also driven by a broader product portfolio now and a much expanded exclusive Chetak network. It's available across 750 cities.
Wider reach, more options.
And a key technical development. The entire Chetak portfolio is now transitioned to what they call a new floorboard battery platform.
What does that mean in practice?
It offers, they say, superior functionality, better performance, and much better unit economics. Essentially, it's a better scooter and cheaper for them to make per unit.
Better unit economics.
Right.
That's key for profitability in EVs.
Absolutely. And some models on this new platform are apparently already EBITDA positive.
Okay, so clear progress on the EV front, both two and three-wheelers. But going back to the overall domestic picture, you mentioned motorcycle volumes were down. What were the general headwinds causing that softness in domestic demand during Q1?
Yeah, it seems like a combination of factors were at play.
Yeah.
They mentioned the advancement of the monsoons potentially impacting rural buying cycles.
Okay.
High urban inflation was another factor, particularly rising rentals impacting disposable income.
Makes sense.
And also, perhaps a growing consumer tendency, influenced by e-commerce sales, to postpone big purchases until the festive season offers arrive.
Waiting for deals.
Kind of like that, yeah. They also noted that while deep rural areas are still struggling a bit, agricultural trading towns are showing some signs of improvement.
So a mixed picture regionally.
Very mixed. And the weakness in that entry-level 100cc segment, that cuts across both rural and urban areas. It's affecting consumers with lower purchasing power and maybe also those facing tighter lending norms from finance companies.
Right. Stricter financing hits that segment hard. So a complex domestic picture for sure.
Definitely.
Okay, let's shift our focus beyond India now. How did Bajaj Auto do on the global stage? Exports seem to be a different story.
A very different and very positive story. Exports showed a real resurgence. Volume grew 16% in Q1,
16% growth, that's strong.
and export revenue actually hit an all-time high.
An all-time high, even with challenges in some markets.
Yes, and here's what's truly impressive, perhaps the standout point in the results for me. Bajaj Auto achieved its highest ever retail sales outside of Nigeria.
Outside Nigeria, why is that so significant?
Because Nigeria used to be their absolute giant market, right? Peaking at maybe 50,000, 54,000 units a quarter. Now it's down to around 14,000, 15,000 units. That's a huge gap, roughly 40,000 units.
A massive hole to fill.
And they've managed to cover that entire gap through growth in other markets. Think Latin America, other parts of Asia.
So they've successfully diversified away from over-reliance on one market.
Precisely. It's not just about recovering lost volume. It's about building a fundamentally more resilient, globally balanced business. That's a major strategic win.
That really puts the all-time high revenue into perspective. It's built on a broader base.
Exactly. And they actually outpaced overall industry growth in their top 30 overseas markets. Bajaj grew 27% there, while the industry average was 17%.
Impressive outperformance. Which regions are leading this?
Latin America and Asia are described as being firmly on the growth path, seeing broad-based, double-digit volume-led growth.
Oh, good.
MENA, Middle East, North Africa remained a bit muted, mostly due to ongoing geopolitical issues there.
Okay. And you mentioned Latin America. Brazil seems to be a key focus for them, right?
Yes, Brazil is a strategic priority. Bajaj Brazil touched 1,000 units in sales this quarter.
Which might sound small, but they have big plans.
Huge plans. Capacity is set to expand significantly, targeting 50,000 units per month by Q4 FY26.
50,000 a month, that's a massive scale up. How are they approaching that market?
Very strategically, their approach is to enter from the top. They started with premium 400cc bikes like the Dominar, which they say has been well accepted.
Establish the brand with premium products first.
Right. And now they're introducing the Pulsar 150. This is aimed squarely at the belly of the market, think the delivery rider segment, a huge volume opportunity.
So top-down entry, then broaden the appeal.
Exactly. They call it a calibrated way of growth. Focus on building a top-class dealer network, ensuring the business is profitable from early on, not just rushing for market share.
Makes sense for a complex market like Brazil. Now, what about KTM? There was some news there, too.
Yes, some welcome news. Exports of KTM motorcycles, which are made by Bajaj in India for KTM's overseas markets, have resumed.
Ah, that had stopped.
It had dropped to pretty much nil for a while. These exports used to be around 5–6% of Bajaj's total exports, so it's not insignificant.
What allowed them to restart?
It's linked to the successful completion of a court-supervised self-administrative restructuring process for KTM AG, which is an associate company of Pure Bajaj AG. Basically, KTM sorted out some financial restructuring.
Okay. And Bajaj's relationship with KTM is deepening too, right?
Yes. They mentioned they are now substantially progressed on seeking the necessary regulatory approvals to acquire a controlling stake in KTM.
A controlling stake, that's a big step.
It is. They expect to get the remaining approvals sorted out in the next couple of months. This really solidifies that partnership and brings a valuable part of their global portfolio back into the fold.
Okay, so strong export diversification, a strategic buildup in Brazil, and a strengthening KTM relationship. A lot happening globally.
Definitely a dynamic picture on the export front.
All right, after exploring those market strategies and the impressive global diversification, let's peel back another layer. Let's look at the financial engine itself. How are they managing profitability and investments?
Sure. So we touched on the currency impact earlier. That lower average dollar realization, 85.6 compared to 86.5 in Q4, did cause that modest drag on sequential revenue and margins.
Right.
However, the good news is the trend apparently reversed a bit in June, and they actually expect currency to be a tailwind in Q2 FY26, helping them.
Okay, so that pressure might ease off. What about costs? Commodity prices are always a factor.
They are. Commodity cost pressure and also some regulatory cost increases like the new OBD2 norms, that's onboard diagnostics for emissions, landed around 70 basis points of impact.
70 basis points? Was that expected?
It was actually lower than their initial estimate of 100 basis points. They managed it better than anticipated, thanks to ongoing cost-saving programs and also getting better rates on seal settlements.
Good cost management then.
Yes. And another positive factor for margins, as we mentioned, was the revival of those KTM exports. That led to a richer product mix than they perhaps initially expected, which helped the bottom line.
So managing costs well, getting a boost from product mix and potentially from currency soon?
That seems to be the picture.
And speaking of profitability, you mentioned that incredible turnaround in EVs earlier. going from deep red to potentially double-digit margins soon?
Yes, that's a really significant point they highlighted. The entire EV portfolio, combining the Chetak scooters and the electric three-wheelers, is now nearing double-digit EBITDA margin.
From deep losses not so long ago. How did they achieve that?
It really comes down to sustained effort in R&D, localization, making more components locally, and smart procurement. It's a clear payoff from long-term strategic investment in building their EV capabilities.
Shows real progress in making EVs financially viable. What about the overall balance sheet? Still looking strong.
Very strong. Described as healthy, with continued strong free cash flow generation. They added about 1,200 crore in cash during the quarter,
Wow, 1,200 crore added in just 3 months.
which brings their total surplus funds to a substantial 16,726 crore.
16,000 crore, that's a huge cash pile. What are they doing with it?
They say it's being strategically deployed across growth vectors, which aligns with their spending plans.
Okay, like CapEx. How much are they investing back into the business?
CapEx in Q1 was relatively modest, around 100 crore. But they plan to ramp that up significantly for the rest of the year, projecting another 600, 700 crore.
And where is that investment going?
It's planned to be split pretty much equally between enhancing their EV capabilities and continuing innovation in their traditional ICE portfolio. So investing in both futures, essentially.
Balancing act. That substantial cash reserve and the planned CapEx certainly suggests confidence in future growth.
It certainly does. And you can see that confidence reflected in another area, their finance subsidiary.
Ah, yes, Bajaj Auto Ltd, BACL. How did they do?
They had an excellent quarter, according to the company. They've now reached over 1 million customers served.
A million customers.
And their assets under management, or AUM, crossed 12,000 crore.
That's a significant loan book. And the profitability.
This is quite remarkable. BACL delivered a profit after tax of 102 crore in Q1 alone.
102 crore profit in 1 quarter.
Yes, and they point out that this is nearly double its full-year profit of the last year.
Double the annual profit in just 1 quarter. That's explosive growth.
Absolute phenomenal performance from the subsidiary. And Bajaj Auto continues to back it, infusing another euro crore into BACL this quarter, taking their total investment up to 2,700 crore.
Clearly, that financing arm is a powerful engine supporting vehicle sales and generating strong returns itself.
No doubt about it.
Wow.
And just one more point on related businesses. Their spares division also did very well.
The parts business.
Yeah, described as a highly profitable business. It grew 19% year-on-year, driven by better distribution and portfolio management. They expect it to keep growing well.
Okay, so strong financials overall, good cash flow, strategic investments, and a booming finance arm. But no business journey is perfectly smooth. Let's unpack some of the challenges and look ahead. What regulatory hurdles are they facing?
Right. There are a couple of significant ones on the horizon. First, new end-of-life vehicles, or ELV, rules are coming into effect from April 1st, 2025.
ELV rules,
Yeah.
what do they entail?
They impose extended producer responsibility, or EPR, obligations, basically making manufacturers responsible for the recycling or disposal of vehicles at the end of their life.
Okay, that sounds potentially costly.
It could be. The challenge right now is that Bajaj says they can't reliably estimate their financial obligation yet because the crucial pricing mechanism for EPR certificates has not yet been notified by the government. So there's uncertainty there.
Uncertainty around costs. What else?
The other big one is the potential mandate for ABS anti-lock braking systems on motorcycles of 100cc and below.
ABS on entry-level bikes. That sounds like a big change.
It'd be huge. They estimate it would create massive supply chain requirements needing 12 to 24 months for the whole industry to adapt.
And the cost.
High cost implications, they say, which in that very price-sensitive 100cc market could definitely have a dampening effect on demand.
So potentially safer bikes, but also more expensive, hitting affordability.
That's the potential trade-off. They mentioned dialogue is ongoing with the government to find solutions for rider safety that are perhaps more effective as well as cost-effective. So, looking for alternatives or phased approaches, maybe?
Okay, regulatory uncertainty is definitely a factor to watch. What about operational challenges? They mentioned a supply chain issue.
Yes, and they were notably transparent about this one. They flagged a specific rare earth magnet issue.
Rare earth magnets. Those are crucial for electric motors, right?
Exactly. Essential for their EVs, both Chetak and the electric three-wheelers. This issue apparently started compromising their production back in June.
How bad is the impact?
Pretty significant. They reported a 50% production shortfall for Chetak in July. due to this.
50%, half their planned production.
Yes. And they expected similar shortfalls to continue in August, about 50% for Chetak again, and maybe 25–30% for the electric three-wheelers.
That's a serious bottleneck, especially given the strong demand for their EVs.
It is. But it was interesting how upfront they were about it. They stated they are intensely focused on resolving it, pursuing multiple options, both short-term and long-term.
Like what?
Things like working with government authorities, trying to develop alternate supply sources quickly, and even exploring different technologies, like using ferrite-based components instead of rare earth magnets where possible.
So, tackling it from multiple angles, when do they expect it to be resolved?
Full restoration production levels is expected by the end of this current quarter, so by September end, hopefully. And they anticipate completely de-risking this particular supply chain issue within the next 6 to 9 months.
Okay, so a near-term hit, but a plan for recovery and long-term resilience. What about the cost of using alternate suppliers? Will that hurt margins?
Apparently not significantly. They don't expect the cost impact from these alternate magnet sources to dramatically affect the bill of materials, so that's some relief.
Good news on the cost front. That dedication to fixing a critical supply issue is impressive. It kind of leads into their overall market share strategy, which they described using a neat analogy, the Rubik's Cube approach.
Yes, I like that analogy too. It implies a constant balancing act, trying to get all the different colored faces aligned simultaneously.
Right. What's the core idea behind that? Why don't they advocate for just going all out, a dramatic shift to grab market share, especially in India?
That's a really crucial point about their philosophy. They believe that simply accelerating market share too rapidly could compromise other vital metrics,
Like what?
like profitability, for instance, or even something less tangible but equally important, like brand love. They feel a reckless chase for share could prevent them from getting all faces of the Rubik's Cube right.
So it's not just about the market share number itself.
No. Their stated focus is on building a very sound business, one that has, yes, growing market share, but also a good bottom line, a good top line, and good brand love, all achieved in a calibrated, sustainable way.
It's about holistic, balanced success, not just one metric.
Exactly. It highlights that challenge of juggling multiple, sometimes competing goals in a really complex market like India. Volume, profit, brand, future tech. It's all interconnected.
A very thoughtful approach. Okay, so looking ahead then, wrapping things up, what's their outlook for the immediate next quarter, Q2 FY26?
They're cautiously optimistic, I'd say. They do foresee some renewed cost pressures on certain commodities, specifically mentioning aluminum, platinum, copper, and rubber.
Okay, inflation's still lurking.
Yes, but they expect their ongoing cost reduction programs, plus maybe some pricing actions, to broadly offset the inflation. So aiming to protect margins.
And the currency.
As we mentioned, currency is actually trending to be a tailwind for the quarter, which should help.
Top positive factor, so overall margin outlook.
They expect overall margins to trend back towards the average level seen in the previous financial year, FY25. And importantly, that tailwind from better dollar realization might also allow them to make a few competitive investments.
Hinting at maybe more marketing spend or tactical moves.
Could be. It gives them a bit more flexibility to compete effectively while maintaining profitability.
Right. So Bajaj Auto's Q1 FY26 results really paint a picture of a company strategically navigating some pretty complex forces, both globally and domestically.
Absolutely. We've seen how they're really leveraging electrification, becoming #1 in E3Ws, the Chetak surge, and pushing premium products, plus that impressive global market expansion, particularly de-risking from Nigeria.
All driving growth, even while they're grappling with those supply chain hiccups and potential regulatory changes.
And that Rubik's Cube approach, that balanced view focusing on growth, profit, and brand,
Yeah.
it's a compelling way to think about building sustainable success.
It really is. It leaves you wondering, what does this tell us about the future of mobility overall? And how will this kind of calibrated, multifaceted strategy continue to shape the automotive landscape, both in India and maybe beyond?
An excellent question to ponder. It certainly suggests that long-term durable growth isn't just about market share figures, but about optimizing that whole complex business ecosystem, getting all the faces of the cube right.
Well, thank you for joining us on this deep dive. We really hope this conversation has given you a clearer, maybe more insightful perspective on Bajaj Auto's recent performance and their strategy moving forward.